My name is Dion Sherwood, and I am an accountant and business advisor to small and medium-sized businesses. My firm is DS Small Business Help Limited, and this is the first in a series of videos we plan to bring both to our clients and a wider audience who want help in understanding things about their accounts, how best to manage their business financially, and also to achieve their goals. What is the director's loan account? If you run a business through a limited company, you've probably heard your accountant talk about the director's loan account, but you're not really sure what it is. You might have been given an explanation, but you ended up being even more confused. Or maybe you think you got it, but then you find out it's not what you thought. So let's try and explain this visually. If you ever run a business as a small trader, then the profits made in that business are all yours, and it goes into your earnings pot in order to calculate your tax and national insurance liability. However, if you run a business through a limited company, sometimes referred to as incorporation, you have in effect created a new person. This person, also known as your limited company, makes sales, buys stuff, it makes a profit, and on that profit, it has to pay corporation tax. Any money in the company belongs to the company. It just needs you to actually make the sales and buy the stuff and turn the stuff that you've bought into stuff that you can sell. But nothing that happens within the company belongs to you except the share capital. And if you're the owner of a small company, that might only be shown on the balance sheet at £100. No doubt you're sat there thinking, but this is my company and therefore anything in it is also mine. Yes, but no. The company has to be treated as a separate person, and to ensure you don't break the law, the Companies Acts, and upset HM Revenue and Customs, you must extract your reward for managing this company and taking the risk in a certain way. To help you understand what I mean, let's consider a sole trader first. If you trade as a sole trader, you'll sell things or your time as a service, and you will incur costs. The difference between your sales and your costs is your profit. As a sole trader, your profit is a little bit like your salary if you worked for another employer. So let's put some numbers in. We've got sales of 80,000. We've got materials and direct costs of 15,000. That's the stuff that you buy to turn into something else to sell. Or maybe if you're a retailer, you buy it and you sell it for a higher price. Then we've got overheads of £10,000. So this is things like rent, rates, travel expenses, telephone, printing, postage, advertising, that sort of thing. It can also include the wages of other people that you employ through the payroll. But crucially, it doesn't include any money you take out for yourself, whether you call it wages or cash drawn. This is not deducted from your profit. So in our example here, we've got total costs of £25,000. which leaves us with a net profit of 55,000. This is the equivalent of you earning a salary of £55,000. And on that £55,000, you or your accountant will calculate your income and national insurance liabilities. And you have to pay that tax and national insurance out of that £55,000. But what's left is yours to spend on yourself, or to do with as you please. If you're in a partnership, the same principle applies, but the profit of £55,000, as in our example, is split between the partners according to the partnership agreement. Often this is in equal shares, as in our example here, but it doesn't have to be. If, however, you have a limited company, the company, as I've already stated, is a bit like a separate person, except this person needs the director or directors to do things for it because it can't do things for itself. Here we have our sole director, who also happens to be a sole shareholder. And here we have our company. Because our director shareholder is one person and the company is another person, we have to find a way of getting money out of the company and into the hands of the director shareholder in the most tax efficient manner without breaking company law or tax law. To do this, we create the director's loan account. It's a bit like a piggy bank where the money goes in and out. So this forms a link between the director shareholder and the company. The director does work as a director and the company pays him or her a salary. It's often a relatively low figure and represents the work he does as a director only. The director is also the shareholder, and as a shareholder, he or she has risked their reputation and sometimes their capital assets to be the owner of this company. So to recompense the shareholder for their risk, the company will pay dividends. These may be quarterly, 6-monthly, or annually. Sometimes the director shareholder might put money into the loan account. If, for example, he uses his personal car in the business, instead of paying for motor expenses from the company, the director will charge mileage to the company. We need a mechanism to get that cost onto the profit and loss account of the company, and the way this is often done is by putting the value of that expense into the director's loan account. Sometimes the director might pay for other business expenses out of his or her own pocket, and the same principle applies, and the money from both sources, whether it's from the company to the director or from the director to the company, gets put into the director's loan account. The director might decide he needs £2,500 to live on, so he draws this cash out of the director's loan account. Sometimes, either without realising or without realising the consequences, the director shareholder will pay for personal expenses from the company bank account. If this is not monitored and controlled, the amount drawn out by the director may be more than he's put in, and there will be an overdrawn director's loan account. So let's try and explain this with some numbers. As I've already said, our company is paying dividends and wages to our director shareholder. And we're going to pay £2,000 in dividends and £700 in net wages. The director has made a mileage claim of £45 and also paid for some business costs out of his own personal bank account for £375. And this brings the total amount paid into the loan account of £3,120. During the same period, our director has drawn out cash of £2,500, and he's also accidentally paid for his car repairs with the company credit card. So that means he's paid for a personal expense using the company bank account. And these two costs come to a total of £3,250. So we have £3,120 paid into the loan account and £3,250 paid out. That means that our director shareholder has drawn out £130 more than has been put in. This means there is an overdrawn director's loan account. So we have our overdrawn director's loan account, and we need to look at ways to resolve this situation. And there are three main things that we could perhaps look at. The first is preferably avoid paying personal expenses out of the company. Pay it out of your own pocket. However, if, as in our example, it was done in error, the director could just reimburse the company with the £750. Another option is for the director to look at drawing a little less cash out. If perhaps he needed £2,500 a month, accidentally paid for the £750, he could perhaps reduce the next amount of £2,500 by that £750. Another option might be to consider paying a higher dividend, but you have to be careful about this, and it's important that you speak to your accountant to make sure that this is a viable option. We have tried to make this as simple as possible, with only one director and one shareholder who happens to be the same person. The principle is the same if you have more than one director and more than one shareholder, and they don't necessarily have to be the same people. We've also used examples to try and explain the mechanics of the director's loan account. However, these items can also be dealt with in other ways. It is important that your accounts are kept up to date and you maintain details of all transactions. Your accountant can help you ensure you don't have an overdrawn loan account, which is not permitted under company law, and also advise you on the best way to deal with your various transactions. An overdrawn director's loan account can also cause an awful lot of problems with taxation. Your accountant can help you minimise your tax liabilities and make things run as smoothly as possible. Never underestimate the value of a qualified accountant who is not only experienced but has a vast wealth of up-to-date knowledge and can help you build your business beyond the basics of preparing accounts and calculating your tax. But if you do get in a pickle and you need some help, then please give us a call on 07977 169 206 or email me dion@dssbh.co.uk.